Good afternoon and welcome to the third annual Marquette University College of Business Real Estate Program. I'm Nancy Haggerty. I am the new incoming chair of the Real Estate Board. And it's been a very busy year for all of us, much so than in prior years, so we appreciate your taking the afternoon to come and see us. We want to say a big thank you to all of our sponsors whose names have been flashing in front of the screen so that they make this possible, and without them we couldn't have you here for the afternoon. And thank you for coming. We know there are a lot of calls on your time, and there's a lot of other events out there, and we appreciate your coming here so that we can tell you the inside information on what we need to know about real estate today. Let me give you a little preview. First up is Professor Mark Eppli, who is the professor who is leading the real estate program and also the interim dean of the business school. As he always does, he finds a way to take all the economic information that's out there in the world and make it understandable to us so that we can do something with it in our day-to-day lives. Secondly, we have three panels this afternoon. One panel of experts from NML talking about that beautiful new building they're going to build after the most interesting process of taking the old building apart piece by piece in front of some of our eyes. They're going to talk about their new tower project. They're going to talk about the decision to stay downtown and why it's important to be downtown. Secondly, we have a panel with our friends from Kenosha who are going to talk to us about why we are seeing such a great influx of businesses that are moving to the Kenosha area, but more importantly, how you have to be ready for businesses to come in here with Todd Battle from CABA and also Jeff Ziegler, who develops all around the country and tells us why they chose here. And then we have a very important project funding panel. We entitled it, How Do I Get My Project Funded? Because that's where we are all day, every day. Charlie Hauser, a student of ours here at the program, is going to speak. And then we have Steve Yastro, our keynote speaker, who's the author of the book Ditch the Pitch, which is being distributed to you today. You all got it when you came in, talking to us a little bit differently about how to do our business. So without further ado, I introduce Professor Mark Eppli.
Thanks, Nancy. Nice start. Hello and welcome. How are you all? Good? Yeah, good day? Well, I'm delighted to be up here, and as Nancy said, I'm here to really kind of set the economic stage for the discussions today around the NML presentation. It's a series of strategies. How do you strategically develop in the urban areas as NML is, and then in more rural areas around industrial, and then kind of a capital markets panel, setting the stage for that as well, and then Steve Yastro is going to talk about strategies for success. So when I start looking at the presentation I put together, I thought a good place to start is where we ended last year. And so we'll start with that. I'll get into some of the GDP, employment, and wealth stuff for a bit. Talk about what drives interest rates and inflation, and then put a little spotlight on multifamily. It seems to be the hottest of the asset classes right now. But so this is where I kind of ended last year. And what I talked about last year was U.S. property markets and, kind of comparing the four different property types and which might do better. And when we talked about that, we said, you know what, multifamily is still hot and will continue to be hot. We can see that on the top blue line. Next, we'll see that U.S. retail has done fairly well, with industrial following, and then from there, office still lagging a bit. Those were the outcomes of what we talked about last time. We also talked about the possibility of the Midwest, the Midwest being a value proposition. Is the Midwest investment market a value proposition? And what we started looking at there is we said, gee, when you start out with an index that we largely stayed with through 2005, but then the Midwest fell behind badly and really hasn't quite picked up. Now what that could look like is it's a terrible opportunity or it's got a lot of yield. In other words, it's a good place to get yield. Is the market looking for yield? Is the market looking to step out beyond the marketplaces of the best markets in the United States, or are they still going to stay, or are they going to stay tightly in those gateway cities? You can start to see that the Northeast market is double what we've done here in the Midwest. From there, the question was, are the big properties that are being sold to the institutional investors doing better, or can we do okay with some of the smaller investments we in this room might be investing in? And when you look at the slide up here this time, what we have here is the GSA CPPI, the red line. That stands for Green Street Advisors Commercial Property Price Index, and that's a REIT index, right? And so what we saw is that market bounced back pretty quickly, and then underneath that we see NCREIF, that's the Institutional Investor Index, and that bounced back nicely. But what really lagged were the smaller properties that are largely tracked by Moody's RCA, that's Real Capital Analytics. And you can start to see, though, over the last year, which is what we started to talk about, is markets or capital is starting to ease out of those low yield cities into some of the more tertiary markets. One of the reasons why the markets can do that is the lenders have stepped up. What I have here is the commercial real estate lending by banks, and you can start to see that it really bottomed out in about 2012, but it really didn't grow in 2013, but in 2014 they're back. And I think there might be some good questions in this slide for the panelists, the capital market panelists that we'll be seeing in another hour or two. The next slide is they're back, but they're also loosening their standards a little bit. That's what the Federal Reserve's saying anyway. And we saw a tremendous tightening. So once you go above 0, that means they're tightening. They're making it more difficult for you to get lump money and capitalize your project. As we start to go below 0, that means they're loosening up their standards. And what we're actually seeing is their standards being loosened somewhat dramatically at this point. A little bit different from, let's say, the single-family residential market where they got quite a bit tighter and they're just not getting any looser. So from there, what this has allowed is the marketplace to have fairly solid transaction volumes. And once again, we have the different colors. You can start to see that the green piece, which is the multifamily market, gosh, that's up there and it's pretty modest. It's actually came down a little bit, but you're seeing a better distribution of property type transactions across apartment, retail, industrial, and office. So it's a nice distribution. It's looking like we're getting back to a normal marketplace from a transaction perspective. So to summarize these slides, I actually used KPMG's survey. I just got this information last week, and it does a nice job of summarizing what we said a year ago that they're seeing for this coming year. Now, the reason why I use that is I still think a lot of these things hold. And let's take a look at what they had to say. First off, they said, they had 4 big bullet points. The last one is international investment coming to the United States. But the first one is significant shift away from Class A in primary markets. So what's happening is the yields have come in so far, the cap rates are so tight that it makes no sense from an acquisitions point of view, and they're going out on the risk spectrum and buying distressed properties, A properties in secondary markets, and B, C class properties. So we're actually seeing that happen right now, in the data I provided showed you that. Investors are turning to new markets in search of yield. What we had was the Midwest market was the worst market from the 5 regions of the United States last year, and it stepped up to being the 3rd best of the 5 this year. So again, what we're starting to see is that the higher yields that we're providing in the Midwest are actually starting to get chased by some of the national players. And then the third thing is multifamily continues to shine. And because that's one of the things they put here, I thought it'd be good to put a little bit of shine a little light on that as well. So let's go on. And let's talk about GDP, jobs, wealth, and income. This is background information to talk about interest rates and inflation. Because without this, none of it, the rest of it makes sense. I'm going to rip through some of this. These are slides I presented time and again. First off, GDP. Here's real GDP. That's how a GDP is measured. And I'm using it a year over year. So you don't see the dip that we saw in the first quarter of this past year from the cold weather. But you can start to see it's pretty modest. We're at 2%. We're in the previous 20 years, so we're at about 2% since 2000. But before that, we were at about 3.25%. So we're not picking up. Even after this bad drop, we're not picking up like we should. But that said, other economies are even doing more poorly. If you look at some of the largest economically advanced areas, the Eurozone, Britain, and Japan, their economic growth hasn't even kept up with ours. You go, gee, I don't really care about that, do I? You should care a lot about that. The reason why you should care a lot about that is because if you start looking at this worldwide, there's slow economic growth. So there's going to be stimulus all the way around. And that's going to force the Federal Reserve's hand as well, okay? From there, we go from GDP to employment. We've seen our unemployment rate drop nicely. I talked 2 years ago about look at 6.5%. When we get to 6.5%, the Federal Reserve is going to move. It's 6.1%. The Federal Reserve hasn't moved. Why hasn't the Federal Reserve moved? Is because the civilian labor force participation rate has dropped in concert with the dropping unemployment rate. So what's happening is a lot of folks are opting out of the job market. Now, it would be one thing if the folks who are opting out of the job market were the 55 and olders as they retire. It's been far less of that, and it's the 25 to 35-year-olds that are the highest dropouts from the labor force. Why do I say that? Why is that important? Because that provides a ready source of employment in the future. 75% of everything we buy is labor, and if we have that in place, we're in good shape. What we have here is simply looking at unemployment is inadequate these days. You also have to look at the labor force participation rates, and we're now at a point going back to about the 1980s, when women were still coming into the labor force. That's how much we've dropped, okay? From there, not all unemployment is created equal. I think I've had the slide up here before. Anywhere from college grads, it's kind of nice at a university to have such a slide. We never really saw an unemployment rate for college grads going over 5%. Now that's college grads who are out and 25 years and older, but you can start to see with high school grads and not high school, the unemployment rate goes up. So there's still a great value on skills out there. Shifting it a little bit, because what I want to do is start getting you in the mindset of what type of spending might be going on out there, how people will be deploying their dollars. It's helpful to look at who's been accumulating those dollars from a wealth perspective. And what you'll see up here is the top 10% of the wealthiest people have about 70% of the wealth. And when you look at it more closely, and what it really means is for 39% of households, they have a net worth of under $25,000. And what's interesting about this slide is that the highest wealth households actually did okay after the downturn, where a lot of the rest of them didn't, because so much of their wealth is tied up in single-family housing, okay? Another challenge that what we call production workers have is since about 1973, their salaries have flatlined on a real basis. So that's an inflation-adjusted basis. You'll start to see that productivity's gone up nicely, but hourly compensation since 1973 has not. So they're not getting a lot more money. That'll start to figure in to how GDP will grow in the future. So when we summarize this, and some of the takeaways here, the unemployment rate drop overstates the gains from jobs. High school graduates struggle. 39% of households have less than $25,000. Real compensation has stagnated. And what that's going to do for a big portion of the population, it'll limit their participation in this upswing, and that will limit GDP growth in the future. So long that GDP growth stays somewhat limited, we can keep interest rates low, or the Fed is likely to keep interest rates low. From there, interest rates and inflation. Let's talk about that a little bit. The 30-year Treasury and the 30-year mortgage interest rate and the 10-year Treasury, you can start to see that we are still at about the lowest rate we've been, roughly speaking, in decades. Certainly we saw slightly lower rates for a period of time, but we're still very, very low relative to history. Now, why is it that we can have such low interest rates today? Is that over the last 20 years, the inflation rate has averaged only 1.88%. It's really been that low. And when you go over the last 20 years, it's been that low. The expectation in the future could be that we could have an inflation rate that's lower than some might otherwise expect, or even the markets might expect. Once again, the red line here being taking out food and energy, so it smooths the lines a little bit. But you can start to see we've had very well-behaved inflation. Inflation will be the biggest part of the interest rate payment you will make. From there, the lender will ask for a real rate of return, but this is the big piece of that, and then also a little bit of a risk premium. Here's what's interesting about that whole earlier comment about Europe. Germany's 10-year interest rate last week fell below 1%. It's the lowest it's ever been. It starts to tell you a story about a stagnating economy over in Europe, and they're going to try to get things kicked off. And one of the reasons for such a low interest rate is that banks have been, I'm not sure I'm supposed to be pointing this, banks have been unable to deploy their assets. So when you start looking at the right-hand side of this chart, you'll start to see this is bank loans to non-financial firms dropping and kind of stabilizing. These are big drops. These are very big drops. And so when you start looking at this, you go, there's still a lot of need for that economy to grow. And so there's a lot of slack, not just in the United States, not just in the Eurozone, not just in Britain, but in Japan as well. So in short, when we start looking at the slack labor markets generally, weak global demand for money and uncertain U.S. growth, and I say uncertain, looks like we're starting to build and do okay again, but remember what happened in the first quarter. We were off by 2% as far as GDP growth. We attributed it to cold, and it looks like that was largely the case, but we're really not accumulating it back real quickly either. And so what that's going to do is it will keep our U.S. Treasury rate in a fairly range-bound, fairly low interest rate environment. Right now at about 2.4%, but I don't see it going up much over 2.5% over the coming year. Possibly watch for tightening after that. There are some of the Federal Reserve governors who are really looking to start tightening sooner rather than later, worrying a little bit about inflation. But I'm not seeing inflation from the global economy, so I'm not that worried about that, and I would like to think that you shouldn't be either. Let's go on. Let's spotlight multifamilies. It was one of the big things that the report by KPMG said is still doing very well. And let's talk about that. So first off, when you start looking at multifamily, look at how much has been added. And when you look at this, the most recent number is about 400,000 units have been added over the last year, given the most recent data point. And that actually is over the long-term average right now. So you go, should that be something we're afraid of? So roughly we're at the long-term average. Does that mean the game's over? Does that mean we're starting to overbuild multifamily? I'd suggest no, not yet. In part because the idea of the single-family house being the American dream may not be the case. It might be the American nightmare for at least 17% of the households who own a home and have a mortgage. It's underwater. And that resonates with a lot of the folks who aren't even in the market. They go, this isn't a great place to be. I'm still having, whoops, there we go, now I went twice, right? There's just a lag. Sorry about that, everybody. And let's look at a couple of other headwinds. And I took this right from the Wall Street Journal. When you start looking at it, first off, the income from first-time home buyers going down. Secondly, the credit score necessary to get into the home has gone up by about 50 points. And that deletes a lot of folks from the marketplace. Thirdly, prices have gone up a little bit, and you'll start to see that the first-time home buyers are a far smaller part of the marketplace than what they've been historically, down by about 12, 14 points from what they normally have been. And so once again, that starts to show you maybe greater demand for multifamily over the longer term. Y'all are patient. And that's revealed in the home ownership rates, largely due to what I would call technology, the technology of mortgage underwriting. We had increased the number of homeowners by including Alt-A and Subprime loans, many of those folks also had the risks of those loans put back on them, so you had the most vulnerable population having adjustable rate loans. It's a bad structure. And we can see that a lot of that blew up, but we're now back to home ownership rates that are about where they have been historically. So we're not going to see a lot of that growth coming to the marketplace from falling home ownership rates, okay? So it's got to come from other areas. Let's talk about those. And oh, by the way, here's your home ownership rate by different age cohort. And you can start to see on average home ownership rates have dropped by about 5%, right? From 69.2%, the high point, now down to about 64%. And we're seeing it right here, and that's where they are. And it's falling most for that 25 to 44-year-old age cohort. I'm afraid to do it again. Okay, so how easy is it to go out and buy a home when you've got big mortgage or a big a student loan? On average, 70% of the students now graduating from college have mortgage debt. The number is about $33,000 at a 6% interest rate in a 10-year term. They're saddled with $366 payment every single month. Again, limiting their ability to go out and buy a home. This is, so I went back to some of the census material, and this is a very interesting slide as well. If you go tick back to 1947, and I think I had this slide last year in some of my presentations, about 21% of all households were non-family households. And these non-family being a census-defined term. And what we've seen across time is more and more families becoming non-family households. It's single person, it's two people living together that are unrelated, and other heads of households that are not family, a man and a woman with a child under the age of 18. As you have fewer and fewer of those in that cohort, you have greater and greater interest from a demographic perspective in folks who rent. And generally speaking, these households have far less income, meaning they're more likely to rent as well. Another big push. Here gives you some examples of the 25 to 34-year-old cohort. That 35 to 34-year-old cohort, we've seen their incomes drop, and we can also see the percent that own homes drop as well from the state of the nation's housing market. So in summary, look at the multifamily market takeaways. There's our numerous home ownership headwinds. High school graduates continue to struggle with employment and real wage growth. College graduates as well are having some hard times. And the investment benefits of homeownership are being questioned. And we may be in the initial stages of an experiential society. I'd like to spend a couple of minutes on that on the next slide. But overall, this yields a continued strong multifamily market. So this last one is something I want to throw out to you all and have you start thinking about. And we're talking about, in this case, what's more of a renter society or a sharing economy, a collaborative consumption or Netflix economy. And how will that affect not only how we are housed, but also the many other choices we make and how it will affect retail, for instance. So if it's more about experiential and leasing rather than ownership, what's likely to happen to your retail store? How large will that space have to be? What will your inventory look like? Will you have inventory? If it's about, we can go out and buy jeans and blue jeans, Levi's for $30 a pair, but those aren't the ones that are being bought. They want a more unique experience when it comes to buying that pair of jeans. And when we start looking at what we can do from a collaborative consumption point of view, the American idea of owning is dissipating, not just with real estate, but with many, many other things. And I think it could also figure into what some of our other panelists will be talking about today. So that's where I'd like to end some of my comments. Do we have time for 1 or 2 minutes, or should for 1 or 2 questions?
No, go ahead.
Yeah, let's go. A couple of questions.
Home ownership percentage is declining, but it doesn't show it's bottomed out. Do you see it dropping further, or has that reached a level where you expect it
I don't know if everybody heard it. Home ownership rates are declining from 69% in that slide in about 2007 to about 64% today. But it looks like it's still declining. I think it'll start bottoming out, but we're not there yet for some of the factors we're seeing up here. And I think it'll be the really difficult thing, John, is that we're into a new environment where maybe owning a home is not the greatest thing to do. Look at it from what I would recommend to my students, for instance. So students graduate from college, they're 22, many of them say, hey, should I go buy a home? I got a job. And I go, no. If you go buy a home immediately out of school and then you get a job elsewhere or your company wants to transfer you, you end up being constrained. You want to maximize your human capital, and instead they buy a home and they can be constrained by their financial capital. And when we start looking at the numbers of jobs people are holding every, within their lifetime, it might have been 3 or 4 for some of us, but the new set of folks, it's many, many times that. And also, they want to experience things, and you can do that far better from a walkable neighborhood, oftentimes associated with multifamily housing. I think what's going to happen is that we will continue to have fewer homeowners and first-time buyers into the next number of years, and we'll drop that from 64% to 63%. Shouldn't go below 62%, but that's a pretty low rate. We're going back to where we haven't seen for some time. Great question. Another? Take 1 or 2 more. Okay, the question was, what about supply and demand? And what we're seeing here is rents continuing to grow for the renters, while owner occupants aren't seeing that same growth. And the question is, what about supply and demand as we go forward? When you start looking at the set of attributes that are going to keep some of these folks away, what you have had in the past is many family environments. That's going away. 1. So we're seeing, from 1947, about 20% being non-family to over 50% today. Second thing is a big demand driver when you start looking at it are minorities, and both Hispanic and African American minorities have less than a 50% home ownership rate across all areas, and that's the population that's growing. When you start looking at the behavior of some of the young adults likely changing. That's not something that we've seen before. So I don't know what that's going to look like. I think that will further add to this situation as well. And the reason why I believe it'll still continue to decline even with that, because they don't have the money for that first home purchase. I do have to say, with some of the changes within FIFA, and they're the regulator for Freddie and Fannie, debt will become more available to the single-family home purchaser through Fannie and Freddie more easily, but not easy enough because they won't have the equity to put into a home. Okay? One last question in the back. The question is labor force participation rates. And actually, labor force participation rates have dropped for all age cohorts under 55 years of age. So over 55 years of age, they actually have increased. One of the reasons why they've increased is because of some of the uncertainty around their retirement funds and their homes being devalued over the previous 5 years. They're unable to retire. But if you look at all the previous cohorts, and especially the 25 to 35-year-old age cohort, they've dropped out of the labor market at 5 to 6% rates. What are they doing? I don't know. Guess. They're probably living in your basement somewhere. Maybe you can describe that better than I. But anyway, thank you for those questions, and that's it for my presentation.